Hello everyone and welcome back. My name is Greg Furman and this is the Forex Weekly Outlook for the week of March the 25th, 2019. Now, to get started this week, we're going to begin where we always do with that all-important US dollar index. We can see that as we've talked about in previous weekly outlooks, the dollar tends to form a cycle around the beginning of the month where we've got dollar strength, the end of the month, and the first week of the new month. That continues to be present here despite what we've seen with the FOMC. Now, using our verified support zones, we can see that the dollar has come down to a known area here. And of course, it was driven down here on Wednesday by that completely off-script FOMC announcement. They're not hiking now. They're not going to hike at all in 2019. They're probably going to cut in 2020. So once again, completely catching the market off guard. But in my respectful opinion, what I've talked about with my own direct clients and in VantagePoint's live training room, that there were signs that there was something wrong earlier in the week when we didn't see the US-Japan move higher with that equity rally. The US Swiss Franc also not moving higher. They're both moving lower. Now, I'll talk about that more in a minute, but for now we can see a clear signal that the dollar is strengthening despite the damage that's been attempted by the FOMC. We've got our medium term crossing our long-term predicted difference that is consistent with the neural index and a rising RSI. Now, once again, using the RSI is predominantly designed to be used for momentum. So we can see that the angle of the RSI were above 50 and now we're looking at breaking above 60 to show us that momentum. Now, we look for these types of signals off verified support levels. We can see that we got exactly what we were looking for here. So when we go back and look at the additional indicators, we're now breaking above the T-cross long at 96.03. And more importantly, looking at our predicted moving average by itself, we've got 2 days in a row closing above this line right here. This is again after we've had another top in place in the dollar. We've sold off. You can see that the market is using the VantagePoint predicted moving average here as a pivot area on a daily basis. So we're fine with selling as long as we stay below this area. But the second we start closing above it, we look to change our position, close out our shorts, and go long. So this is pointing towards dollar strength. Our monthly cycle supports that. So we should see the dollar at least hold on to some gains on the start of the week. The area that you want to watch to begin the week is, of course, 95.68. Now, with that said, of course, gold is the immediate benefactor of dollar weakness. But again, in this particular scenario, I believe that the victim will be the stock market, not the dollar and not gold. I believe that gold and the US dollar will move up together if we move into a risk-off environment. So right now, when I'm looking at gold, a little bit of weakness in that medium term crossing the long predicted difference. So at least for the next week and a half, the dollar is probably to see more gains than gold, but gold is holding its value here. RSI is moving up, our predicted MACD also doing good. So until that neural index turns red and the predicted differences start pointing down, gold is likely to remain firm with a critical support now at 13.12. Now, when we look at our long predicted by itself, you can see the market just hugging this line, and that area is 13.82. So that's the area we're going to watch to begin the week. Now, looking at equities once again here, guys, you know, we're failing yet again. We're trying to break above and stay above this 28.33 level, but as you can see, the market is there's just no buyers up here. When we look at the verified zone, as I've talked about, we have a very clear identifiable sell zone on this verified support level, and every time it's come up inside this area, the market has failed miserably. Now, I can't say definitively based on the credit markets and some of these things that the US is going into a recession, but it certainly does look like globally that is the case. In Canada, Japan, Europe, numbers that came out on Friday were absolutely horrific. So when we look at this, we can say this is really not the greatest environment for stocks, to be perfectly blunt. However, when we look at this critical level, 2808.67, the T-cross long, that is held 2 days in a row, When the buyers come in, this is where they're coming in at 28. So if we can stay above 28, maybe the equity rallies can make one more rally, back towards that 29.30 mark. But my optimism on that at this time remains heavily guarded, as we can see a growth globally slowing down. So again, not the best environment for stocks. When we look at the medium term crossing the long predicted difference to the downside, our RSI is clearly warning us here several days ago that we're losing momentum on this particular trade. The neural index turning down. Not a lot of positives here for stocks, to say the least. Now, that is also dragging oil prices down also. You can see that oil following those global equity markets, if there isn't a lot of growth on the horizon, then there isn't a lot of reason to be buying oil here either. So oil and the S&P and your major global indexes are likely to move together here. So right now, 58.04, a breakdown below that next week. We'll see we'll see oil accelerate to the downside. But we need a consistent, steady close below 59.10. We've got our first day after this basically 8 or 9 day rally. A nice little rally up here. You can see how it's hugging the VantagePoint predicted moving average. You can see that my charts, are very simplistic. We don't need to bring in additional third-party indicators here to clutter up our screen. We can see everything we need here with these core VantagePoint indicators, our triple cross, our long predicted, our predicted differences, our neural index, falling RSI. All of these are telling us that any upward momentum in oil is at least stalling. Now on Friday, some of that is profit taking. I won't dispute that. So we'll watch this and see where we're at by midday Tuesday to see if equities and oil can recover or if they sink further. And if they go down, the next move in the dollar, or on the S&P 500 could be significant. And what I mean by significant, that if we can't hold above the 2800 mark for much longer, or get above 2833 and stay above 2833, the area that I've talked about for the last 5 long months, then the equities are going for a much bigger move to the downside. Now, when we talk about the euro here, I had mentioned in the beginning of the presentation that the numbers out of the eurozone on Friday were absolutely horrible. Sorry, I don't mean to laugh at it, but it's just they were very, very poor numbers. So when we look at this, once again, we've got these verified zones up here, repeated failure marks here. We're trying to push higher. The only bar we've got higher is the Fed bar from Friday, where the market reacted by what the Fed had stated, because it was such a shock to the market that everybody, including myself, counted on at least one more rate hike in 2019, and then we get a statement in early 2020 that there's not going to be any more hikes, might even look at cutting, but we got that now. A very, very dovish Fed, but that wasn't enough to save the euro. It's still pushed lower. So right now we've got our medium term crossing our long term predicted difference. Our RSI, a leading indicator, basically on Wednesday and Thursday told us that this was a fake move to the upside. We've got our verified zones up here providing resistance, and sure enough, down we go. So the next likely target here is the lower verified support zone. That'll come in at or about the 111.76 area. But if equities really tank here, the euro could move aggressively lower. Now, once again, the euro does respond to those cycles in the dollar index at the beginning of the month. We've broken down below VantagePoint's key level, 113.42. That's the area to watch to start the week, in my respectful opinion, and a decent area to start looking at shorts. Now, with US Swiss franc, I had mentioned at the beginning of the presentation that it was a very unusual move here. I talked about this extensively in VantagePoint's live training sessions, that look, if the equity market rally last week was real, then US Swiss franc and US Japan would be screaming higher. And that is the exact opposite of what happened. When we look at this, again, this is science, guys. We're not guessing at stuff using Fibonacci or Elliott wave or some form of accumulation distribution. We're not guessing at any of this stuff. We're applying real science, verified zones, intermarket correlations. When the intermarket correlations don't match, it's a leading indicator that tells us that something is very, very wrong here. So as it moved lower, we're starting to base out. US Swiss franc, I suspect, will move higher next week back towards the parity level where it's likely going to fail yet again. Now, this pair will be decided by the equity markets, so keep that in mind. If the stocks keep moving lower, so will US Swiss franc. And right now, I can see a very, very thin buy signal trying to form here, that medium-term predicted difference crossing the long predicted difference. So with the dollar strength at the beginning of the month, any move higher in this particular pair is likely corrective in nature. Now, as we move into our additional pairs, the pound dollar bouncing all over the map, but failing again up here anywhere above this 133 area. We just simply can't get buyers to step in here with Brexit and everything else. Right now, again, you really are at the mercy of the Brexit and news announcements if you're trading this pair. But to start the week, we look very, very slightly bullish on this pair. But I believe the dollar strength as we start moving towards in the latter part of next week will again push this pair down. So we must break through these massive resistance levels that have been sitting there for a considerable period of time. Our most recent high now, 133.78. That's the area we've got to break above here, guys, if this pair has any chance of breaking higher. Now, if they get the extension they're looking for, I believe they have on Brexit, that should help the pound a little bit, but I'm not sure next week is the week where it's going to see a lot of strength. I think it'll probably be the week after. Now, with dollar yen, once again here, guys, as I had stated at the beginning, there was something rotten in Denmark here for me. When I looked at this last week and I saw the global stock markets, but more specifically, the S&P 500 is the one that I watch to gauge globally how the markets are doing, more specifically the US markets, but still globally. So when we look at this and I see the dollar yen moving lower, the direct intermarket correlation is if the stock markets are going higher, then US Japan is going higher, US Swiss franc is going higher. That was not happening. So when it started failing, I immediately warned people to be careful of a big sell-off coming in the S&P 500, or the Fed is not going to be, we're not going to get from the Fed what we're expecting, and we certainly didn't get that. So right now, by the looks of it, the dollar yen is going to go lower. My concern is maybe we've moved a little bit too far, a little too fast. I expect some kind of a retracement back towards 111.02, and we'll reassess at that particular time. But again, this particular pair is largely based off of the equity markets. If the equity markets are doing poorly, then we want to sell this pair. If stocks are moving higher, predominantly we want to buy this pair. So right now, this pair from the beginning of the week pointed that this was going lower, meaning stocks were going lower. And that is exactly what happened after we had a couple of false breakouts to the upside. Now, as we come into our three main commodity currencies, US CAD is on the move yet again. We can see a clear buy signal, our medium term crossing our long predicted. That is supported by the predicted MACD. The RSI getting a little bit overbought, but again, that's not necessarily going to stop this pair from moving higher. What I think could stop it is this swing high at 134.67, this verified block of resistance here, again, between the areas of 134.67 and this swing high at essentially 136.63. This predominantly has been the sell zone, but for now, if the equity markets continue moving lower, US CAD will move higher. If oil moves lower, US CAD will move higher. The direct intermarket correlations, is a driving factor with this pair. So right now, we want to look at the area in the week where we want to start a starting point, and that's what it is, a starting point. We look at this and say, okay, the market's been hugging this long predicted. Now on Thursday, we break above it, despite that ultra dovish Fed, right? But remember, the Bank of Canada is equally as dovish as the Fed. So when we look at the two economies, Canada is going to get the short end of the stick on this one, in my opinion. So when we look at this, we're closing above that key level. Then we use that level to accelerate higher. You can see how the market springboarded off that long predicted at 133.68. So that's our obvious target area, along with the VantagePoint predicted low for longs to start the week. But we've got to be cautious here around 134.67, because again, that's still a very significant resistance zone that has been in place for the entire, basically the better part of the calendar. Or actually, that is the high for 2019. So if we break above that, chances are we could run, but we need the support of stocks selling off and oil selling off. Now, our final two commodity currencies, I think that Aussie has had just about enough here. It's tried desperately to get through this verified resistance zone, as we've identified here in the VantagePoint software, up to this level, up near 71.41, and there's just no buyers up here. Once again, this points towards a stock market sell-off. That's what it looks like. So again, you know, what I try and do because this is an outlook, I'm not looking backwards and showing you what you could have done. We only look forward. That's what an outlook is, right? So we have to anticipate our opponent's move next week. We do that by looking at these intermarket correlation and looking at the key indicators. We're breaking down, closing below 70.94, not by much, only about 20 pips. But now we've lost that long predicted, and we're closing below that too. So 70.96 to start the week is still a reasonable short. Looking at the indicators, we've got our medium term crossing our long predicted difference to the downside. It's supported by the neural index. We've got a falling RSI. So again, the majority of the core indicators are saying this pair is going lower. But if stocks turn around, that will boost this pair. But at this particular time, that seems rather unlikely. The same thing goes for New Zealand. I think if we're looking at shorts, I would lean more towards New Zealand US than Aussie US. There's trades there on both, but New Zealand has been the stronger currency in the month of March. So likely New Zealand in April is probably going to be the weaker currency. So I think there's a little more value if we're going to go for shorts. We do have a short signal here, but we need the neural index to support a short trade. The neural index is still green, positive, so we're not quite yet ready to go short, but as a leading indicator, something that tells us ahead of the market that something is going to change, is clearly the medium term crossing the long predicted difference. Overbought and oversold signals really don't tell us much of anything, to be perfectly blunt, right? So we've got to look for something that's based on multiple market correlation, 31 other markets. That's what we're looking for. So for now, when we're looking at this and we click on our F8 on our VantagePoint software, our key pivot area is 68.60. If we lose 68.60 at the beginning of the week, then we would look to sell a break of that particular area, suggesting that we're in a risk-off environment and the majority of the so-called commodity currencies are getting ready to move lower. So with that said, this is the Forex Weekly Outlook for the week of March the 25th, 2019.